Hello everyone, how's it going? Welcome to my channel where we explore the interesting investment and trading ideas. If you're looking to buy Faraday Future, then keep watching because we're going to look at the company's recent news, how the market has been treating the company, and what are the technicals telling us. And most importantly, what is the best trading approach? As the market remains very volatile, we should always be mindful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Now, let's take a look at the technicals of the stock. The trading volume of Faraday Future has recently been around 2.9 million shares versus an average volume of 1.4 million shares. Over the previous 52 weeks period, the price fluctuated between $6.20 and $105.60. The market cap of Faraday Future is currently around $116 million versus the enterprise value of $165 million. As we compare the current price to its historical price fluctuations, the stock is 1% higher than the 1-month low, 1% higher than the 3-month low, and 1% higher than the 52-week low. On the options market, which often gives us a hint on the market sentiment on where the stock price is probably going to head next, the implied volatility is 131% versus the historical volatility of 155%. The put-call volume ratio is currently around 0.5, which means that almost half of the options contracts currently traded believe that the stock will tank. It's normal for many stocks to also have a higher put option volume than what they truly deserve because many institutional investors hedge their long positions. The most recent volume of options traded is 5.5 thousand contracts a day versus the 30-day average of 3.7 thousand. Regarding the open interest, most recent interest is around 240,000 contracts versus the 30-day average of 295,000 contracts. The options market are tools allowing traders to hedge their risks, increasing their exposure with limited downside or even a revenue stream. They are the derivative contracts based on the underlying security. They also give traders the possibility to buy or sell the security at a predetermined strike price and helps limiting the potential downside. The put options allows selling at the strike price, usually chosen for anticipated downturn, and the call options allows buying at the strike price, usually chosen for the anticipated bullish run. In terms of the shareholder structure, institutional shareholders own about 125% of the outstanding shares, the biggest shareholders including Vanguard, BlackRock, and Fidelity. Usually, it's better to see some institutional participation when holding a stock long term because it offers a layer of stability and token of reliability in the medium to long term. It means that the market is confident that it's going to deliver value in the long term, an important factor to consider for investors. I personally believe that the minimum threshold should be around 25 to 30% for institutional ownership. There are many exceptions for this rule, as there always will be great companies mostly owned by retail traders. The current short interest is around 22% of the total float, and 63% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant portion of the short volume coming out from the dark pools, it may suggest that there are institutional positions taken to short the stock, and that there would be potential to short squeeze. In this case, given that the interest is 22%, I personally believe that there might be a case for a potential short squeeze. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflations. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions instead of choosing ETFs. Now, let's talk about, Faraday Future just a little bit. Very, very often people believe that this company is just a scam. It's not a real company, it doesn't have a real product. But we have seen that even for companies like Faraday Future and Molan, production seems to have been throttling along, bizarrely, if I may say so. So they still managed to roll out something, and they still managed to give the market the message that they are not like a hopeless case. They're not just here for the shareholders' money. They're not just here to scam people off. They're actually here trying to produce something concrete. Whether they manage to do so or not is another story, but at least the intention is there. The other thing is they're all like very short-term speculative positions. In other words, most of the people trading them, they don't really have the expectation that they're going to make, huge investment deals with Faraday Future. They know for a fact that they're in for the short term and they're fine with it. It means that the risk profile is higher and the expected profit to be generated from this should be like, both, how can I put this? It should be quick and high at the same time. So my recommendation overall for Faraday Future is to buy a little bit of it. Like, don't put too much of your chips in this kind of position, but do know that the expected volatility with this kind of stock can sometimes be gigantic. And this especially applies for stuff like Faraday Future, where we know that there's not much to look at, but sometimes there might be one of those irrational moves from the market at large, which causes the stock to really tumble upward.